ready.
May I have your attention, please? If you have not done so at this time, please silence all cell phones and pagers, and please sign in. Thank you.
Thank you. This meeting of the Louisiana Tax Commission is hereby called to order. This meeting is being held at the offices of Louisiana Tax Commission at 1051 North 3rd Street, Suite 225, Baton Rouge, Louisiana. The time is 10:02 p.m. Today's date is Wednesday, March 28th. Let's call the roll.
Chairman Shahardy. Commissioner Wagasback.
Here.
Commissioner West.
Here.
Commissioner Vercher.
Here.
Commissioner Wood.
Here.
4 present and a quorum.
Okay. Being no old business, we'll go ahead and move into the approval of the minutes. Can entertain a motion for the approval of the minutes of March 21st, 2018 minutes.
So moved.
Second.
Commissioner Vercher.
Yes.
Commissioner Wagasback.
Yes.
Commissioner Wood.
Yes.
Commissioner West.
Yes.
Chairman Shahardy is absent.
Okay, we'll move into the appeals. Let me read this into the record first. It is the Tax Commission's policy to accept all documents into the record that were timely pre-filed in accordance with the Commission's rules and regulations. This will be done at the conclusion of all hearings on today's docket. Accordingly, there is no need to formally offer or introduce exhibits into the records during your appeal hearing. However, if you intend to object to the submission of any of the opposing parties' exhibits, you must notify the Commission at the start of your appeal hearing. As a reminder, this is an administrative hearing, and as such, the rules of evidence are relaxed. The Commission is inclined to review and consider all evidence submitted and to accept such evidence into the record should this matter be appealed to the District Court. Let's go ahead and swear everybody in. For now, we may have to swear Orleans Parish when they come in later. Okay. Do y'all want to?
You're going to testify today for any of the
Yes.
on any of the appeals before the commission. We swear all the witnesses in at once. So go ahead and approach the table. I'm sure most of you have done this before. I'll administer the oath. Please approach any of the microphones, affirm the oath by stating "I do" and state your name for the record. Please raise your right hand. Do you swear or affirm the testimony you're about to give is the truth, the whole truth, and nothing but the truth, so help you God?
Charles Dickey. I do.
I do, Jay Trevino.
I do, Gail Badewski.
I do, Sally Costley.
I do, Ed Cherie.
I do, Belinda Hazel.
I do, Charles Grady.
I do, Orson Billings.
I do, Patrick Matthew.
Okay.
We'll swear the
Sure.
Orleans Assessor's representative.
If I can entertain a motion at this point to go ahead and move to the personal property section, and we'll move K and L to the top of the appeal agenda.
So moved.
I'll second.
Okay. So this would be appeal, we'll go ahead and hear a personal property appeal noted as K, appeal of Connecticut Partners LLC versus Cameron Parish.
And I'm going to do a roll call vote on that move.
Sorry.
Commissioner Vercher.
Yes.
Commissioner Wagasback.
Yes.
Commissioner Wood.
Yes.
Commissioner West.
Yes.
And Chairman Shahardy is absent.
Are we going to consolidate these two, or is it the same issue, or do you want to hear them separately? Separately? Okay, sure. All right. Cameron Parish up first.
Sir, can I get your name again, please?
Orson Billings.
Jay Trevino.
J-A-Y-T-R-A. Yeah.
Okay, taxpayers represented, go ahead and introduce yourself. We want to start.
Okay. My name is Jay Trevino. I represent Connecticut, the Gator Plat LLC on this appeal, and with me is Sally
Pull the mic closer if you don't mind, so we can all hear, get on the record.
And you want to repeat myself, or?
Yeah, please. If you don't
Okay,
mind.
my name is Jay Trevino. I'm a consultant for Connecticut Partners LLC, which is part of the Gator Plant appeal. And with me is Ms. Sally Costley. Again, she's a consultant with me that representing the Connecticut Gator Plant. Part of our appeal is for the reason that there was no obsolescence given to us for tax year 2017. And before I start, Ms. Costley would like to go ahead and present the her hearing memorandum that she has prepared for this group. And I give you Ms. Sally Costley.
Yes. Gator Energy is an affiliate of Connecticut Partners LLC. The assets that Gator Partners or Connecticut Partners purchased are at, I believe, 3115 Highway 82, Grand Chenier, Cameron Parish, Louisiana. There are two accounts associated with these assets. One account is the taxable account, which is under appeal, the 120007895, and assessment number 7200000100 is the tax exempt account. Both accounts appear on Mr. Billings' tax roll in Cameron Parish. The rendition that Mr. Billings submitted as Exhibit 1 is incomplete. It does not include the Lat 5A. Do you agree, Mr. Billings? That there are two accounts? Oh, okay, sorry. There are two accounts on your tax roll representing Connecticut Gator Energy LLC.
One is on the tax exempt?
One is on the
tax exempt roll,
Yes.
and the other is the Gator processing plant in Grand Chenier.
Well, they both represent the Gator processing plant in Grand Chenier. There's two accounts.
But one of them has not been, is not being assessed as on the active tax roll. The other is the one that has the ITE has not been, it is assessed on the.
It's on the tax roll,
Yes,
but
sir.
it's tax
Yes,
exempt.
It's
The,
on the exempt roll.
Yes, the exemption will has expired
Right.
as of December 31st.
Okay.
But the PSA includes the assets on both accounts.
Are you making a statement, or are you actually questioning him?
I'm asking him a question. Does he agree that there's two accounts on his tax roll that represent Connecticut Gator Energy LLC?
One is on an exempt entity and the other is not.
Right. Those two numbers, I think. Do you have those? Anyway, I went to the tax roll on the Louisiana Tax Commission and printed both those. There's two accounts. And on the Cameron Parish Tax Collector, it says on the 7-2 account that it's tax exempt. But those are the assets that Connecticut Gator Energy purchased. And if you take the minimum purchase price and do an allocation, we're talking about 28% to the taxable account, which represents a value, fair market value, or a value which includes both the purchase price and the earnouts of 1.44982 million, or assessed value of 217,473. I think my rendition, I reported a value of $295,390 assessed value. And also, there was a lot of mentions in the memo that this was a gas gathering line. Connecticut was reporting under Connecticut Midstream Energy gas gathering lines, but we found out from the engineering department with Connecticut that those lines actually belong to the jurisdictional or the FERC-regulated public service property, and we have reported those lines to the Louisiana Tax Commission started this year.
I guess I'm a bit confused, so I'm trying to clear it up for me.
Okay.
Is the assessment being contested or appealed today, the assessment number, as you stated, the 120007895, which shows an acquisition cost of roughly $6.7 million, assessed value of $773,000? Is that the one we're looking at?
Yeah, we're talking about the
'Cause I don't have any information concerning this exempt info, nor do I have
Well, we
any.
didn't appeal that because it
Obviously,
it was
it's
exempt.
Yeah.
Yeah, but, you know.
So are you saying that what's on this assessment should be on the exempt?
No, there needs to be, as far as the purchase price or the purchase price plus the earnout should be allocated between the taxable account and the exempt account. Because the PSA includes all the assets that are on the taxable account, the 1200, and the exempt account. And roughly 28% is on the taxable account and 72% is on the exempt account.
And may I add that the assessment that Mr. Billings came out on our property is a total value of what was represented from the PSA. So if he's stating, he's overlooking the fact that the exempt account should have been included in that PSA, which he didn't include. He strictly was a assessment that we reported to him, the taxable amount.
So your argument today is a allocation of the purchase price?
The allocation and the obsolescence. We requested an obsolescence like the previous year. We can
Okay.
go back 2 years and.
Can you give me the total purchase price again that you?
Well, you know, they say in the PSA the total the purchase price is the 2.5. The earnouts, we don't know exactly what they'll be total yet. We'll know that on the end of July of this year. I have a balance sheet, and the balance of the purchase price plus the earnouts as of December 31st, 2017, a year after the assessment date, is $5,6,336,897. And like I say, we won't know the total of the earnouts until July 30th.
What was that number again? 5 million what?
$5,636,897. And if I do the allocation on that number, I'm coming up with an assessed value for the taxable account, the 12007895 of an assessed value of $235,745.
What's the fair market value?
The fair market value would be $1,571,634.
You mentioned 72% of the purchase price going to the taxable account, right?
Yeah, and I based that on, when I looked at the tax bills I printed out, you know, the taxable value, which the assessed value, the taxable on the taxable account was $773,091, and the tax exempt account was $1,999,714. So I just based my allocation on those numbers. I think the allocation based on the gross investment of both accounts, you know, the taxable account was somewhere around 25%.
But the number again that you reported on your lat filing was what?
The fair market value of $1,969,268. Fair market value.
We would also want to add to the fact that the reported cost numbers for the 2015, 2016, and 2017, it seemed that the Cameron Parish in 2015 accepted the numbers that were reported. In 2016, we had an appeal before before the LTC, and the numbers that were reported to Cameron Parish was never an issue. Now, going back to 2017, they added almost $300,000 to the cost amount, and I was curious to find out why they did it. And in doing an analysis of the cost numbers that they were reported, there was 4 items where, and you have to remember that these accounts were rendered by Plains Gas Solutions and not Connecticut. So the numbers in 2015 and 2016 were the numbers that reported by the other company, and they were never an issue with Cameron Parish. When we came around in 2017, now there's an issue where they raised the value of the cost by almost $300,000. So we're saying, and there was a couple of instances where they did increase the cost, and there was a couple of instances where they reduced the cost, but Cameron Parish decided to take the full cost of all of them. In other words, they didn't reduce it because they increased one because it didn't reflect the year before, but they didn't take into consideration why did we report it a higher, or why did they report a higher cost. So we're being a little inconsistent where now they're going back 2 years and picking up cost numbers. From 2015, there was never an issue. In 2016, there was never an issue, and then all of a sudden, we reported what we reported in 2016. Now it's becomes an issue where the cost went up. And I'm wondering, why are we doing this? Do we have to go backwards to figure out what happened 3 years ago? So, and if you throw those $300,000 into the mix of things, yeah, there is going to be a fluctuation in the final assessed value or fair market value. I do have diagrams if you want me to present to the court the 3 years of assets and how they reflect the amounts at this fair market value if you wish to look at them.
That's up to you if you want to submit it. Just make sure the assessor gets a copy. Do you want to discuss the obsolescence next, or is?
Well, I've based the obsolescence on the throughput.
On what?
And what was going through the plant, like has done in the past. Oh, sorry. The plant engineer said it was constructed or designed to have 300 million MCF a day. But because of the compressor configuration, it could only do the 120. I confirmed that through a news article when CDM Max was building it. It was designed to run 300 million a day. And if you look at one of the exhibits that was submitted last year, in the year 2012, when Plains was running the plant and submitted the rendition, they said plant design capacity was the 120. But if you look back for year 2012, the average was 189. So obviously something changed. Orson, do you know if there was a rental compressor on your tax roll
For that plant?
out there?
I do not know.
Because, you know, then 1 month with July, they were running like 210 through it. So I'm saying, yes, it was designed to run 300. And the news article confirms that. I talked to the engineers with Connecticut. He's the manager of measurements. He's been in the industry 30, 40 years, you know.
Do we have any documentation besides the news article? I mean, is there any engineering report that shows design capacity?
No, just the news article. I mean, it's a standalone plant. There's not like a bunch of pipe. I mean, I guess I could get, you know, the registered professional engineer to put his seal on it.
Well, I don't know about the rest of everybody, but I don't always rely on the news because it's not always accurate.
Well, it was, you know, built after Katrina, you know, and a lot of the plants didn't come back, you know. I mean, that's what the news article said. I haven't been able to find anything else, and, you know, this is what our engineers telling us.
You mentioned something about the engineered capacity of 120 million. The newspaper says 300 million. But you did have some throughput verification of 189 million?
Yes, that's what they were running through it in 2012. The average monthly was 189 million. So something. And, you know, the engineer said it was designed to run 300 million, but due to the compressor configuration, it can only do 120.
Commissioner, I'm going to object
I'm real
to
confused.
hearsay. Yeah, we don't have this engineer here to cross-examine unless Ms. Cosley wants to qualify herself as an engineer. I'm very troubled by the fact that, you know, she's making representations about what somebody else told her.
Well, we'll take her figures under advisement, but I'm struggling with if a capacity is 120 and they're running 189, we're all over the chart here with capacity. So I guess I'll let you finish out your argument.
Well, you know, that's what the company official said, you know, was designed for that. I mean, he was with Tennessee Gas Pipeline, A&R Pipeline. He's, you know, knows those plants, and I have, you know, faith in what he's telling me.
Okay, so nothing's been provided by you from an engineer or company rep that gives us any confirmation of capacity, correct? We're just going off of what you've been told or read?
By the basically the plant manager or the manager of measurements with Connecticut Partners.
Okay, so the plant manager says capacity is what?
He says it design capacity. When you do the Chilton equation, that you're talking about design capacity.
Okay, and he said the design capacity is
He
what?
said the design capacity was the 300 million.
And again, Commissioner, same objection.
But due to the compressor configuration, it could only do 120. But it was doing the 189 in 2012, which tells me that something happened with the configuration. I'm thinking there was probably a rental compressor out there, and you know, since the economics went down, they were losing money, they probably released the rental compressor.
Okay,
That's it.
all right. Anything more on
No.
obsolescence? Okay. Your throughput, what was your average throughput on the year that we're discussing now?
Your average what?
Throughput? That's what I'm trying to get to. You're stating in one of your exhibits a 60% obsolescence.
Okay. The average for was 72,300, and I use the design capacity of 300,000. So utilization was 24%. And I did put on there, it was designed for 300, but however, with the current compressor configuration, the plant can only move a max of 120. And you know, I looked at it again, and if I take the rules and regs, if I take, well, the historical costs reported on the LAT 12, the 600,474,420, plus the LAT 5s of 17,902,044, and then there's another for LAT 5A for another industrial tax exemption of 1,138,771 plus another one for 45,000. So the total historical cost of 25,561,093. Okay, then I applied the index to that cost to come up with a indice to get the current cost in 2017 of a 300 million MCF a day plant. I came up to roughly a little over 29 million. I said, okay, the current configuration is the 120. So I came up with another factor, economy of scale, a Chilton type equation, the Chilton equation. So I said that was like approximately 78% of the 29 million. It gives you the current cost to build a 120 of 16,980,653. It's only running at 24% of capacity. Oh, it'd be running at 62% of capacity of 120. So I come up with the Chilton at 68% and come up with the, based on in utility, replacement cost new, yet less the in utility of 6,881,889 for a fair market value on the taxable account. Using the 28% again, I came up with 1.9 million, 26,929. That's a fair market value of 1,926,929.
The 28% represents what again?
The 28% of the taxable account.
That's
the taxable account on the plant, the total plant. So basically what I did is I knew what, historically, a plant designed to run 300 million, so I used an indexing, bumped it up to today's, or to 2017 cost, that's the year we're talking about, to get a total RCN of approximately 29 million. So I said, well, it's configured at 120 MCF, or million MCF. Applied the Chilton again. The 120 divided by 300 to the 0.6 came up a factor of approximately 57.7%. So I took the 57.7 times the 29 million, and I'm coming up with the replacement cost after the physical depreciation using the rules and regs of 10 million. But it's running at 62% of the capacity of 120. So I'm coming up with 68%, and then
I think that part of the formula right there is where the argument is at. That's not,
the formula.
No, that portion. Your
The Chilton?
throughput, the Chilton.
Mm-hmm.
I mean, I'm not making the argument for the assessor, but I think that's probably what we need to concentrate on.
Mm-hmm.
Your explanation as to why.
Well,
Why is to the 68%?
Right. Maybe I shouldn't have stopped you. The two parts of that formula are the 300,000 and the 120.
Okay, well, there's two parts of it. One part, I'm trying to get it down to a 120.
Okay.
Replacement cost new as of January 1st, 2017. Okay, I get it down to the 120 replacement cost new. I'm at, okay, indicated cost to build a 120 plant in 2017, 16,980,653. Less the physical, 60%. And I used the table 25.03. 2503.C. It's 10 years old. So 60%. Now I'm coming down to 10,181,391 for the replacement cost new, less physical on 120 million MCF a day. It's even when it's designed.
Well, you took the 10 million and then you did 28% because that was the percentage.
No, since even the design, if it was designed at 120, it's not running at full capacity.
Okay, let's start from the top.
Yeah.
You said earlier, 2017 replacement cost new was 29 million.
Yes.
Correct?
Yes.
Okay. Then we're looking at 120 million MCF capacity, right?
Right.
120 divided by 300, you came up with what?
We'll raise to the 0.6.
The point what?
The exponential.
Okay, so the 0.6 would be basically the utilization, right?
Yeah.
Okay.
We know what it costs to build a 300.
Okay, so let's continue the math.
Okay,
Let's continue the math.
Okay.
Okay.
Okay, and the economy of scale, bringing it down to 120, is 0.57707. So the indicated cost to build a 120 in 2017 is $980,653.
So let's stop there. That is the replacement cost new based on that utilization.
Yeah, that's the replacement cost new of 120 million MCF a day in 2017.
All right. Now, how do we get to the 10,181,391? Is it a 16,980 minus?
Okay, now we got to take off the physical depreciation.
Correct.
And that's 60%, it's 10 years old. I use table 2503 C. And I'm coming down to the 10,188,392.
10,188,392.
392.
Okay.
Okay.
Let's
Okay, if, you know, we're talking of it, and even
let's continue on till we get to the
to the bottom line?
Yeah.
Okay. Okay. It's running at 62% if it's rated at 120. So again, using the Chilton, I'm coming up with 68% in utility. Because if you build one at 120, it's still not going to run at 100%. It's still not, you know. So using that,
haven't you taken that factor already into account above?
I took it into above to get it to a replacement cost new of a 120. But even if it was built for a 120, or the way it's configured now, it's the max it could do is 120. But it's still not.
Now, is the max 120 or is the max 300?
It was designed for 300, but due to the compressor configuration,
It can only do 120.
it can only do 120.
So you have to take that cost of the 300 million MCF cost of 29 million, and they said to replace that, we're not going to reproduce it, we're going to replace it, it's going to cost it that much money. So you have to take that 180 MCF that's unfeasible to use. So now we're going back to 120. That's where we started, 120, which is the value that's just coming up. And now we take the physical out of that, and then we take the obsolescence out of that, and we come down to the fair market value, or tactical value.
So, you know, replacement cost new, less physical, less the obsolescence in a 120, I'm coming down to 6,881,889.
What's your obsolescence figure?
%68.
You have a dollar amount?
No, I don't have a dollar amount. I guess that would be the difference between the, you have a calculator? No. It looks like it's roughly 3 million. And that's for the entire plant, both accounts. And so, you know, the way I reported it and calculated it, it's pretty much in line with what I'm coming down to again. I'm coming down to a fair market value for the account, you know, using the 28% of 1,926,929 fair market value per account that's taxable.
Which is roughly 28% of the $6 million number.
Right.
Which is, includes both accounts.
The $6 million includes both accounts. So, I mean, you know, So I'm, you know, checking myself this way. If there's an argument.
I follow it. I'm just not sure I totally agree with it, but
Well,
I do follow
understand,
it.
I understand.
Okay, is that it?
Uh,
Well, oh yeah, I'm sorry.
Go ahead.
There's only one other thing that we did have,
Pull the mic closer.
another thing we did want to consider is the, in his, number one, and Mr. Eddington had provided us with the information that some previous lawsuits that transpired back in the early 2000 years. And since he's saying that Louisiana is a self-reporting state for ad valorem tax, again, he's referring to all these lawsuits based on pipelines. And he continue on to show the throughput of pipelines. And he continues on to say, as for the inefficiency of Kinetic's charts, which purported to show the underutilization of the pipelines, we're not talking about pipelines, we're talking about the plant. There's a lot of difference between a pipe and a plant. So he's misleading the facts that it's not a pipeline we're talking about the plant. Also, there was something that pretty much stated the fact, in short, the sole issue raised by this appeal is whether Assessor Billings committed reversible error when he rejected Connecticut's obsolescence request. I'm confused. What judgment is he referring to that would be an irreversible error? I would say that, Mr. Billings, I was going to ask what error of sufficient gravity was done to warrant reversal of a judgment on appeal. Is he referring to last year's appeal, or is he referring to this year's appeal? And number two is, did he not miscalculate the fact that he didn't use both accounts to come up with the fair market? He only used one account? So there's a disparity we're having, and I'm thinking, okay, what reversible error are we talking about? What is, I mean, I'm confused. I don't understand it. If he could address that, he would.
Well, let's let them testify. Maybe they can address some of those matters if they so desire. And
I've got a slew of questions before we get to Mr. Billings' testimony.
Okay.
Ms. Costley, let's talk. You gave a lot of discussion regarding an allocated purchase price. You had stated different figures. I think you said roughly 20% of the purchase price was allocated to the taxable income.
I mean, are you talking about it on the books?
No, I'm talking about your testimony earlier, that the purchase price disclosed in the purchase and sale agreement. You said that that was portioned in part, and I think you used a figure, only 20% of that was attributable to the taxable assets, and the other 80% was attributable to the exempt assets. Or did I misunderstand your testimony?
Okay. I went onto the tax roll and pulled up both accounts. The taxable account, which I'm assuming is the assessed value.
You're assuming, or you know?
It is the assessed value.
Okay.
I mean, it's on the tax roll, the $773,091. And then the exempt account, the taxable number is $1,999,714. Okay, if you add, and then I got them to 100% for a total fair market value of $18,485,367. And then based on that, the fair market value of the taxable account and the fair market value of the exempt account, I did an allocation.
Okay, so you did it purely based upon the mathematical relationship between the assessment listing for both the taxable and the exempt property. Is that correct?
That's correct.
Okay,
And I also double-checked it using just straight historical costs, the gross, and the taxable account was 25%.
And did you provide any of that information to Assessor Billings? Because I don't see it in either your exhibits or his file.
I didn't have any idea where Mr. Billings was coming from until I read your
Okay.
pre-hearing brief. You
Now,
know,
you-
I didn't realize that he thought there was just the one account involved in the purchase. There's actually two accounts involved in the purchase.
Well, you're not suggesting that Assessor Billings did a sales price valuation, are you?
Well, he requested the PSA, so I'm assuming that it would be something that you would look at and see if your number was, you know, in line.
Okay. Also, earlier when you were going through a long set of calculations with Commissioner Wagasback, you were reading from a spreadsheet that you're holding in your hand right now.
Right?
Was that spreadsheet ever provided to Assessor Billings? Again, I don't see it in any of the exhibits.
Again, I didn't, you know, I put on the throughput exactly what the engineer told me, you know, as far as the design and the rating because of the configuration. I was transparent, you know. I didn't know he could have emailed, well, I have a question with this, you know. I didn't realize what his thinking was until I saw the pre-hearing memorandum.
I don't recall seeing in our packet either. Would you be willing to provide that to the assessor
I'm going to object
staff?
this introduction at this point.
Okay.
I mean, that's kind of trial by ambush to drop this on us the day of hearing. I'm just trying to establish that it was never provided to anybody. Also, Ms. Costley, if you look at your pre-hearing memoranda, you referenced that you provided a comparative cost statement, which you list as Exhibit 3, page 1 of 2 to Assessor Billings. Is that correct?
I think I provided that in my exhibits to the tax commission.
Exhibit page 2 of 2 or 2 of 1? Again, these are your exhibits, but I've got them right here for you. Let me read from your pre-hearing memoranda. The assessor was also provided with a comparative revenue and expense statement, Exhibit 3, page 1 of 2. That's page 2 of 2.
I think there's not a page 1. The income statement is on one page.
Well, I tell you,
This is
what I'm looking at.
This is what I have from your.
Oh, okay.
So Exhibit 3, page 1 of 2, you did in fact provide to Assessor Billings, did you not?
I provided that to him.
And this
yes.
is in essence the same information that you provided the prior year, correct?
The prior year was reported by Plains.
But you were involved in the appeal of that matter, were you
Right,
not?
right.
And this is similar to the information that was provided?
It's similar
Right.
information.
Okay.
It was accepted in the past, so I provided it.
Well, as you noted in your pre-hearing statement, the tax commission raised some issues regarding the sufficiency of that document last year, did they not?
Well, I thought it was, you know, how can you do an income approach if you're...
Let's back up. I'm asking questions right now. You're not testifying. The tax commission raised some issues regarding the sufficiency of that statement, of that document that was introduced this year as page 1 of 2 of Exhibit 3.
Mm-hmm.
Correct? So, in addition, you provide to the commission a more robust income statement, which is Exhibit 3, page 2 of 2. Is that correct?
That's correct.
That information was not provided to Assessor Billings, was it?
No, it was not.
Okay, thank you. You had made a comment earlier, and I think that I can probably kind of cut to the chase, and please correct me if I'm misunderstanding, that I'm hearing that there are two primary errors that you are asserting, two things that Assessor Billings did wrong. One, there is this claim that he added $300,000, slightly in excess of $300,000 to the original cost that you did not report. And secondly, that he did not include a reduction in value for obsolescence. Okay, let me start this again. I want to make sure I understand your argument that Assessor Billings did two things wrong. One, and Mr. Vienier, I think you're the one that brought this up, that there is approximately $300,000 in historical cost that is not included.
It's included in the 2017.
That's included in his assessment, but was not reported on your rendition.
No.
Correct. That's incorrect?
The information we reported in the rendition was exactly what was reported the year before.
Okay.
Then nothing had changed, so when I took that when we did the report, we sent in the information as to exactly what was the prior year.
Okay, let me ask you this again. I'm trying to figure out what you are alleging Assessor Billings did incorrectly. And he included, his original cost figure is approximately $300,000 higher than yours.
Correct.
Correct?
Correct.
And it is your assertion that it was an error for him to use the $300,000 higher number.
Well, let's go back to 2 years.
No, I don't want to go back to 2 years.
The only way I can answer your question is to show the steps of what happened in 2017, if you would allow me.
It's a real simple question. You rendered amounts.
Correct.
Did the assessor change it by 300,000? Yes or no?
Correct, yes.
Okay,
He raised
answer.
it by 300,000.
And you're saying that he should not have done that? Yes or no?
No.
Very simple question. Okay, also, there is an assertion that Assessor Billings should have included a reduction in value for obsolescence. Is that correct?
Yeah, yes.
Okay. Are there any other errors in Assessor Billings' assessment other than the $300,000 and his failure to include a reduction in value for obsolescence? Anything else you want to put on the table?
If we're going to we're going to go over your rebuttal we're going to go some rebuttal to your assertion as to what happened, why we're doing what we're doing.
No, I'm not making an assertion yet. I'm asking a question. I'm trying to figure out what we're asserting, and I'll be candid. I'm having a very tough time. You've given a lot of testimony. It's been all over the map. It's been very, very difficult to follow. I'm simply trying to figure out, we've identified two assertions of error. One, that Assessor Billings improperly included approximately $300,000 in his historical cost calculations. Correct?
That's one.
Okay. And two is that he failed to include a reduction in value for obsolescence.
That's correct.
Okay. Are there, other than those two issues, and I'll be candid, I am unaware of any, are you asserting that there are any other errors or mistakes that Assessor Billings made on this assessment?
Just the fact that he didn't apply the obsolescence yeah, that's it.
Okay, those 2 points. Right. Let's start talking about obsolescence. First, Ms. Costley, you testified that you based obsolescence on throughput. Is that correct?
That's correct.
Okay, I would like to provide you a document that is part of Assessor Exhibit 1, a copy of the rendition on the assessment ending in 7895. It's a one-page document. It's titled Connecticut Gated Energy LLC 2016 throughput by month. I'd like to show you this document. Got a big heavy tab on it. Is that the document you provided to Assessor Billings?
Yes.
Did you provide any other documentation regarding obsolescence to Assessor Billings?
We provided the purchase and sale agreement.
No, regarding throughput. You said that you...
Not throughput.
Okay, and again, your claim for obsolescence is based solely on throughput, correct? So your claim for obsolescence is based solely on this sheet, is that correct?
Ms. Aitken, what exhibit are you looking at?
It's part of Assessor Exhibit 1. It's their rendition. In mine, it is, I believe, the 4th page after the cover sheet. It's a table.
Or is it in
Article to Assessor Billings?
it's readily available on the internet, but no, I did not provide him with that. I wasn't aware he had any questions concerning the discrepancy there.
Regarding the discrepancy in the 300 that you reported and the 120 MCF rated capacity that was reported the prior year?
That's correct.
Okay. So you provided no supporting documentation as to the rated capacity of this plant, correct?
No, I did not.
And you provided no supporting documentation showing the actual throughput levels, did you?
I did provide documentation concerning the throughput.
And what document is that?
The chart.
The chart. So again, this is the only document you provided as the basis for throughput, which is the sole basis of obsolescence.
That's correct.
So on obsolescence, this whole case hinges on the sufficiency of this one page, correct?
Well, that in the purchase and sale agreement, I mean, the sales approach to value, obsolescence is inherent in it. Is inherent, you know, or the income approach with making a negative income. I mean, you really can't do much of an income approach.
Are you suggesting that Assessor Billings performed an income approach valuation?
No, I'm not suggesting
Are
that.
you suggesting that he should have?
Well, when it's not making money, it's rather difficult to do an income approach.
Okay. And to do a full income approach analysis, he would need a great deal of financial data, would he not?
An income statement.
And did you provide him anything other than this summary document, which is Exhibit 3, page 1? Did you provide any other financial information to him?
No.
Okay.
So just so I can confirm, the LAT form was provided, and then this attachment to the LAT form, it's called Attachment to LAT 12-Obsolescence, which is kind of that recap of revenue and expenses. That's it?
That's it.
Okay.
What has been done traditionally.
Okay. Also, you had made a comment that there was probably a rental compressor on site. Are you testifying that there was a rental compressor on site? Do you know?
I don't know.
Okay, so that was just speculation on your part.
Speculation.
Okay, thank you. No further questions.
The rental compressor that you actually talked about, though, was in prior years to as extra support to push more than 120 through the plant. Is that correct?
Well, yes, correct. You
Okay.
know.
So it didn't really have anything to do with last year anyway.
No, it was
Okay. So it's immaterial.
Yeah.
All right.
Any rebuttal, any questions?
Yeah, well, I've got some questions that I want to ask Mr. Billings in regards to,
Are they calling him their case in chief or is rebuttal because I haven't done direct exam yet? I'll play it however you want.
I'm sorry, I thought you said, okay.
Oh, no.
You're finished with your question.
I'm sorry, I'm finished with
I
my questions
misunderstood.
of them. I do have questions for Mr. Billings, and then I can tender them unless they would.
Present your case. I thought you said it's all you had.
Okay.
Okay.
No, I'm sorry, I was less than clear.
yeah, we're going back, and I'm looking at his.
But time out.
Hold on.
Mr.
I'm sorry.
Addington needs to finish his
Dennis is not
presentation.
finished yet.
Let
Okay,
it go.
go ahead.
It'll be easier. Mr. Torino, it's
Yes,
all
sir.
yours.
Oh,
Okay.
yeah, I'm coming back to what the, Mr. Billings had provided, or he had said on his rebuttal to the, to this hearing, and he just went on through the calculations of the, purchase and sale agreement, to the fact that we bought the plant in 2016, and they had requested a purchase and sale agreement, which we didn't submit. We had it redacted, and if we go back to last year's, the previous assessors had only requested that we cannot talk to you about this plan unless you're the proper owner, and which we were. She didn't. The previous assessor did not want to find out what the PSA stipulated, just to want to know if we were the owners. I said, yes, we can send you that. Make a long story short, now we're back to the same thing. It says how much of the consideration, the payout, earned payout, not to exceed. I mean, you can read all of that. And then he's coming up with the value of whatever, $5.1 million. And he's talking about the revenue increased over 251, expenses increased just under 130, and cash flow increased from a negative to a negative. Bottom line, if you're losing money, you're losing money. It doesn't make any difference if you made $1 or you lost $100. You know, you're losing money. So to me, the income is irrelevant in this deal.
It is irrelevant, but let me ask this question, because you keep,
Yes, sir.
And maybe we can cut to the chase.
Right.
If you look back in the prior year, the average daily delivery was 41. I'm just using from the schedule, 41,947. You had a utilization factor of 35%. Right. We jump forward a year, the average jumped to 62,677, but all of a sudden we got a utilization factor of 20.9%. So it appears, okay, things did improve a little bit, but to keep my costs down or look at it a different way, we're going to use 300 instead of 120. I'm looking at it from the assessor's point. Boom, there's a red flag. Something's not right. We're going up in capacity, but we're going down in utilization. Same plant, just a different year.
And then we're going back. We're going back to the design capacity of the plant.
So you change the formula. From one year to the next, you change the formula. That's what changed what you put on the lat file. In my opinion, I haven't heard from the assessor yet, but it appears to me that's what this argument is about.
And that's why we asked several times, do we have any type of engineering report? We need some type of documentation or certification of the capacity. Because obviously that swings the utilization tremendously if we're going from 300 million to 120. So we're trying to give the benefit of all obsolescence due to the taxpayer, but we got to understand, what the true utilization is.
And it might have been a little different when you're buying it than when you're operating it.
I mean, he could have changed the equation. He could have said, I'm going to use the 120 and put that in there.
So maybe we ought to hear from the assessor. And
yeah.
Are y'all through before I move on?
And I'll have a question. What do you foresee an engineering study would look like? Would he just sign an affidavit, put his registered professional engineer stamp to it, or what?
That's a question for him. We're just kind of looking for evidence to support our
Uh-huh.
decision, okay? And right now, it's just kind of, I guess you would say, for lack of a better word, hearsay.
Right, right.
Okay.
And then, another allegation in the pre-hearing memo was saying, our records and financials were not audited. Well, they are in fact audited at the consolidated level, which includes the Gator Energy Plant. I mean.
Understood. Your amounts were extracted from the audited financials, we would assume.
Well, then that actually I'll raise a question. Ms. Costa, did you provide any of that audited information to Assessor Billings? Yes or no?
No.
Okay. Thank you. Assessor Billings, you had heard discussion earlier, and I think I finally have this straight, that the taxpayer is asserting two errors in your assessment. One, that you overstated the historical cost by approximately $300,000, and two, they're challenging your failure to consider a reduction in value for obsolescence. Are you? I'm so sorry. Are you aware of? Well, just to cut to the chase, do you know what they're talking about when they're talking about this $300,000 difference and their reported historical cost and what you actually utilized in determining your value?
As was done in the past, when we take a platform that's returned to us, and we come across a piece of equipment that has a different cost than the prior 2 or 3 years, and normally it's less, then we use the historic cost, what they reported to us originally as the cost of that equipment.
And so was there in fact such a deviation in the 2017 report submitted by Connecticut?
Yes.
Yes, okay, and you can tell me what asset you located that you came up with a different historical cost for?
The second one from the top, the expander, GC.
Well, tell you, let's stop right there. If you go to Assessor Exhibit 1, and I believe it is the third page, the first page right after the actual renditions. It's a document, it has a header Connecticut Partners LLC, but then it says attachment to Lat 12. Commissioners, it's a long spreadsheet with some handwritten notes across the bottom. Okay, so again, the document I just described, again, the third page of Exhibit 1, this is the document you're referring to?
Yes.
You said the second entry, and this is an expander GC?
In 2016, they reported a cost of $176,110.
Okay.
And then further down, the Granchenier reballer replacement regenerator, I assume. In 2015, they reported a cost of $475,832 as compared to $470,655.
Okay.
And then a couple lines down, the Granchenier plant regenerator gas piping. In 2015, they reported a cost of $827,560 as compared to $595,140.
And you use those higher numbers that had been previously reported, correct?
I used the historic cost.
And this was, again, numbers that were provided by the taxpayer in prior years, correct?
Yes.
Okay. And those three changes, those account for the $300,000 error or difference that Mr. Trevino was referencing. Is that correct?
Correct.
Okay. On their request for obsolescence, I know in prior years, Connecticut and their predecessor, Plains, had requested obsolescence on this plant, did they not?
Yes.
And you had previously told them that the level of information they provided in those years and they provided this year was insufficient, had you not?
Yes.
And they provided nothing to you that they had not provided before, did they?
Right.
But they did also provide you with the PSA, the purchase and sale agreement. Actually, I think it's listed as asset purchase agreement. Did they not?
Yes, they did. In September.
Right. And did they provide any, let me go on more close, I'm sorry. Did Ms. Costley, Mr. Trevino, or anybody else on behalf of Connecticut provide you with any information by which you could have done an allocation analysis of the purchase price?
No, sir.
Do you even know what the purchase price is at this time?
I assume, according to this agreement, 5.2 million to maybe 10 million.
And that's all you can tell from the documents you were provided?
That's all I've got.
And this document, in fact, was not provided to you until September the 13th, is that correct?
Correct.
More than a year after you first requested this document?
Yes.
I have no further questions.
Okay.
Please answer any questions the commissioners might have.
Any questions?
Yeah, I have one for Mr. Billings. On this information of the assets that we say that he went back, number one, who reported these assets in 2015 and 2016? Was it Plains All American?
Plains.
Plains. And you accepted those numbers as rendered?
Yes, I did.
Okay. We come along in 2017, and you changed the numbers we reported the same numbers that Plains reported the year before. Why are you singling us out to say we didn't report the assets as historical cost? if we follow in the pattern that was done the year before and the year before that.
If it was reported differently in 2016 or 2015, and I did the assessment, then I used the historic cost, what was reported before.
Why did you not pick up these numbers in 2016 on the first appeal?
I believe they were.
No, sir. We brought the assets, and we took the reported assets, asking for obsolescence, and we reported the assessed value to the Louisiana Tax Commission, and they approved it based on the facts that these were the correct asset or correct cost of the assets. If they would have changed, you would have made documentation, and I would have probably agreed to it. But in this respect, the numbers that you went from 2015 to 2016 to 2017, you raised the numbers that were lowered, but you didn't lower the number that were raised by Plains. Why? If Plains gave you 850 million and Plains reported the following year 520 million, yeah, you bumped it up to 300 and something million or whatever. But if the numbers in 2015 was, let's say, 100 million, and the following year the reported value was 200 million, oh, you kept the 200 million. You didn't bring it back down to 100 million as it was in 2015. In other words, you're picking and choosing the numbers that will give you a higher, I feel, that will give you a higher number.
Are you saying, an assessor, I'm gonna ask y'all both at the same time because I'm confused as all get out, but are you saying, and I'm gonna pick the reboiler replacement. Prior, your rendition shows 470,000. The assessor says this in prior years the historical cost was 475,000. So boom, there's a difference of round numbers $5,000. Are you saying that jump up a couple of the screens are at 17,000? That if they would have went down to 16, the assessor wouldn't have picked up the 16, because it all adds up at the bottom to 6,474,000. Is that what you're saying? That the assessor chose to use the historical average? Because I think he's correct in what he did with the information that we have.
The 6,474,000 is the prior year, 2016. This year, the year under appeal went up from 6,474,000 to 6,732,000. That's a difference of 300,000.
The information that I'm reading from is the spreadsheet that Mr. Eddington just referred us to.
Right.
And the testimony, as I heard it, the $300,000 that we're arguing about is because the assessor used prior information that was different than what you reported this year. Is that correct, Assessor?
Yes.
Does anybody have the 2016 rendition as part of their exhibits?
No, ma'am.
And the biggest difference is on the Grand Chenier plant regeneration gas piping.
That's correct.
It went from 595, but historically it was 827, I guess it is?
Yes.
560?
Yes.
Okay. Was any part of that gas piping disposed of or sold?
That was prior to the Kinetica Energy picking up the plant itself. These are the questions where Plains Gas Solutions should have brought that to their attention when they filed the report, not after the fact.
Well, did y'all make sure, like you're saying these are the numbers that they had filed before, that Plains had filed?
Mm-hmm.
But a new company has purchased it, and y'all would need to make sure that you had the right assets here, and did y'all do that, or did you just take the 2016 numbers and put them on 2017? Because I'm confused now.
Yeah, we went back and we took the 2016 rendition that was reported to the Louisiana Tax Commission, to Cameron Parish, and we reviewed those numbers, okay? When the assessment came down, yes, those were the Cameron Parish accepted those numbers as rendered, so we were assuming it was correct. Okay, the following year, the numbers go up. Nothing changed, except the fact that they went back 2 years in 2015, what was reported in 2015 to what was reported in 2016 to what was reported in 2017. There was 4 items that the cost changed either up or down. When the cost went up, they picked that higher number. But when the cost went down, they didn't adjust it. They left it what was reported, which was higher than the year before. How those numbers went up, I don't know.
Assessor Billings, do you have any recollection that there were other numbers on here that had changed that you might not have addressed, or were these the only 3 numbers that changed?
These are the only 3 that I can recollect.
And you haven't provided us anything where the assessor didn't recognize a lower number, have you?
Whatever we reported the year before and after the appeal.
No, you're arguing that the rendition was adjusted by the assessor. The lat form was adjusted.
Based on the cost, yes.
I don't think I've seen any exhibit showing what, that he didn't adjust to a lower number or chose not to adjust to a lower number provided.
Maybe to ask the question this way, why did the plant regeneration gas piping go from $827 to $595?
Good question. This information was provided by Plains Gas Solutions prior to our purchase. Okay? If you want an answer to that question, Plains Gas Solutions should be able to answer, but we cannot answer that. We're just following what they reported, what was accepted by the Cameron Parish, and what we reported.
Well, I think we've heard everything we can hear at this point. Commissioners, any other final questions?
No.
Okay, before we do submission of the exhibits, I do want to lodge an objection to the introduction of page 2 of Exhibit 3. This is the enhanced income statement that Ms. Costley acknowledged it was being provided for the first time to the Tax Commission and was not provided to Assessor Billings.
Well, we'll allow it, but
No.
it is noted as not provided to the assessor. So we have noted that. I know I've noted that in my notes, and it's on the record. So we'll allow the submission, but it is noted as has not been previously provided to the assessor.
I would obviously move that the pre-filed exhibits be offered and introduced into evidence.
They are. Okay.
Thank you very much, Commissioners.
I'll entertain a motion to take this under advisement.
So moved.
Second.
Do you request to do any post? No, not necessarily. Okay. All right.
It's already, we had, I think we're here and Bruce had hit everything that was discussed today.
Okay. Thank you.
Thank you, Commissioners.
And a roll call vote of Commissioner Archer,
Yes.
Commissioner Wagensback.
Yes.
Commissioner Wood.
Yes.
Commissioner West.
Yes.
And Chairman Shahardy is absent.
Okay, while in step, we'll go ahead and hear the Plaquemines case. Thank you.
Thank you.
Careful. So next up is L, Appeal of Connecticut Midstream Energy LLC versus Plaquemines Parish Board of Review. That's docket number 17-22075-034. I think all parties have been sworn in, correct? Okay, let's get our notes in line here. Okay, as before, we'll start with the taxpayer. You all ready?
I'm ready.
Okay, go ahead.
Sally Costley here representing Connecticut Midstream Energy. Traditionally, I've provided the assessor's office with the audited financials to request obsolescence. The first 2 years they lost money, and then this year, the tax year 2017, they had a positive net income due to the purchase of TC Offshore. They're gathering assets that are in offshore federal waters. So their income went up, or they had an income. Find the income statement. They had a net income of $2,452,454. Now that's Exhibit 2, page 4. The balance sheet reflects the plant, which includes the acquisition of the TC Offshore in federal waters, a total plant of $4.9 million. So, using the market approach, I'm looking at Exhibit 8, the first page. Based on the allocated purchase price, the assets from Tennessee Gas, the allocated price was $3,840,000, and then the allocated for the TC Offshore was $638,878. The allocation was based on an 8-inch equivalent, it's my understanding, and that reflects obsolescence in the market approach of 96%. And I'm comparing that to the total pipe inventory, which is Exhibit 4, the final page. If I put everything on the schedule, replacement cost due less physical depreciation, the total inventory is $112,566,559. Okay, and then the income approach, I'm using an income of $2.5 million.
You're back on Exhibit 8?
Back on Exhibit 8, page 1, the income approach. Using the 2017 interstate pipeline cap study of 10.7, which is probably kind of low for a gathering line, kind of risky. Most of it offshore federal waters, traditionally has lost money. But anyway, that's what I used. And I came up with the total for the income approach of $23,364,486. I'm comparing that to the schedule of the $112,566,559. Percent good on that, dividing the 23 million of income, the market approach, by the total schedule value of the 112,566,559 for obsolescence of approximately 79.24%. Okay, I calculated the indicated rate of return on the cost schedule. The net income of 2.5 million divided by the scheduled pipe, 112,566,559. Rate of return on that is 2.2. And then looking at a throughput analysis on just the pipe in Plaquemines Parish. I'm coming up using the utilization rate. Well, the second page is actually using what Pritchard and Abbott suggests, running at 14%. Pritchard and Abbott's schedule is Exhibit 7.
Sorry, did you say 7?
Yeah, Exhibit 7. 14%, they suggest using 37.7. So I applied that with coming down to a value in Plaquemine Parish of $1,723,544. And then just using the Chilton, using a 69%, applying it to the pipe in Plaquemines Parish, I'm coming to value $1,405,264. So looking at all the values on Schedule 8, page 404, I'm coming up with a indicators of value. And I believe the income approach is probably the most appropriate one to use.
On the, where you got your operating income, the heading for that document says income state budget consolidated. Is this actually your budget, or are these actual numbers?
Those
Because the budget on the top of it kind of threw me off.
I think these are the final numbers.
I would think it would be, it has December 31st on it, but.
It says budget would also,
Yeah.
if it was so,
Yeah.
I just was wanting to see if it was actual or budgeted, whether that was just a typo.
Well, I provided the parish with the financials for tax year 2018, and actually the income did go down to like 1.8 million. So I projected high.
Okay, so basically you're suggesting the income approach, and that's how you arrived at your valuation, correct?
Correct.
So was that what was provided to the assessor, or?
I provided the financials, the income statement, the balance sheet, and the total pipeline listing updated with the Louisiana schedule. Less physical depreciation.
Now, this is different than the last appeal because this is pipelines.
This is pipeline.
Okay.
This is pipeline.
Okay.
That's it for me.
We didn't introduce ourselves.
Okay, is that your presentation?
That's it.
That's it? Okay.
All right, Commissioners, my name's Belinda Hazel. I'm the assessor from Plaquemines Parish. I have with me Ellen Dunbar. She's our legal representative here today. I'm going to make some remarks that I'm actually going to read because it helps me keep on track and keeps me from flailing my arms and rambling. So here goes. Connecticut Midstream Energy LLC is appealing their property's assessment because in the cost approach to value, a 50% economic obsolescence adjustment was used by the assessor instead of a 70% obsolescence adjustment. External obsolescence facts, I'm going to run through a few of those. External obsolescence is one of 3 types of depreciation considered in the cost approach. The other 2 are physical depreciation and functional obsolescence. External obsolescence is the loss in value resulting from a factor or factors outside of the boundaries of the property. There are 2 kinds of external obsolescence, locational and economic. Locational obsolescence results from a property's location near something that causes a loss in value. Economic obsolescence is the loss in value due to economic conditions, such as the cost of materials, or reduced demand, or increased competition. The form of economic obsolescence considered today is inutility, which is operating at less than full capacity. Inutility is measured using throughput. Throughput data by itself does not indicate obsolescence. It is important and a part of the story, but not the whole story. In the determination of economic obsolescence, other considerations must come into play. Textbook economic obsolescence theory says a plant, or in this case a pipeline, operating at close to full capacity doesn't necessarily have zero obsolescence. If the plant is operating at full capacity but not earning at a level similar to the past or not returning a reasonable return on the investment, economic obsolescence may exist. Throughput does not stand alone, but must be considered with the other facts and circumstances of the business. The flip side of operating at the full capacity is a pipeline operating at less than 100% capacity, and it does not necessarily suffer a loss in value from economic obsolescence. Other reasons can apply. When a plant or a pipeline is not operating at full capacity because of economic reasons, the inutility is considered economic obsolescence. When not operating at full capacity because of something like a bottleneck, the inutility is considered functional obsolescence. When not operating at full capacity because of a physical problem, such as deterioration, the loss is physical depreciation. Connecticut rendered 69.5777 miles of gathering pipelines in Plaquemines Parish. As an aside, I like the internet too. The Connecticut website shows 100 miles of pipeline in the South Pass system, but that is a discussion for another time. Connecticut rendered a 70% economic obsolescence factor for 2017. Connecticut rendered a 70% economic obsolescence factor for 2016. Connecticut rendered a 70% economic obsolescence for this year, 2018 as well. Connecticut provided overall throughput of 14% for their entire system using data for the year May 2010 to April 2011, the data submitted with the FERC filings. As an aside, the throughput reported for the South Pass system in Plaquemines Parish was 22%. Connecticut reports no changes in their pipeline utilization. 70% obsolescence based on a 14% utility is Connecticut's year-in and year-out rendition. In their rendition, Connecticut allocated $3.84 million of the $32 million total acquisition from Tennessee Gas Pipeline to the gathering lines and allocated roughly $639,000 from the more recent 2016 TransCanada acquisition for a total allocation of $4.5 million. Connecticut provided a current income statement. The story revealed by the income statement is one of financial improvement as compared to prior years. Connecticut credits the acquisition of the additional pipelines from TransCanada in 2016 with moving the company out of the red and into the black. Connecticut's net operating income for 2016 was approximately $2.5 million. Connecticut developed all three approaches to value, sort of, and those are Exhibit 8 that we've just looked at, so please look at Exhibit 8. For the market value approach, Connecticut declared the $4.5 million allocation as market value of the whole system, and using the allocation calculated an economic obsolescence factor, which was then used as an obsolescence adjustment in the cost approach. The market value of the South Pass system based on Connecticut's cost approach adjusted for obsolescence by the sales comparison approach was $182,000. That's the first approach on page 1 of their exhibit, and the last page, page 4, is the calculation. Connecticut's version of the income approach followed a similar pattern. The income approach was used to develop the value of the whole Connecticut system, and that market value of $23.4 million was used to develop an obsolescence factor for the use in the cost approach. Connecticut's cost approach value, adjusted for obsolescence via the income approach, suggests a market value for the South Pass system of roughly $949,000. Connecticut's market approach and their income approach are not market and income approaches at all, but are cost approaches using market approach and the income approach to develop an adjustment for economic obsolescence, and that's okay. provided the input is valid. In the two traditional cost approach values provided, Connecticut adjusted for inutility using the same Chilton factor formula that was removed from the Commission's rules and regulations in 2008. That value was $1.4 million. In the second traditional cost approach provided by Connecticut, they adjusted for inutility using a formula that Connecticut labels as the Pritchard and Abbott service factor. The value is $1.7 million. In both of the last two versions, Connecticut bases the analysis on the overall capitalization or overall utilization rate of Connecticut and not on the utilization rate specific to South Pass in Plaquemines Parish, which in 2010 and 2011, when their data was from, was higher. The three approaches to value, market, income, and cost, should not derive the exact same values, but values should fall within a reasonable range. If not within a reasonable range, there is typically a flaw in the analysis. A market value of $4.5 million for the whole system, as concluded in Connecticut's cost/market approach, and a market value of $23.4 million for the whole system, as concluded in Connecticut's cost/income approach, are not within the same value range. And looking at the value spread for the South Pass gathering system on page 4, that value range being $182,000 to $1.7 million, again, is a very wide spread, suggesting something is wrong. Because allocated values typically have more to do with book value and tax consequences than with market value, it is reasonable to assume that the $4.5 million allocation used as the indication of market value is questionable, which eliminates the giving of any weight to Connecticut's $187,000 value conclusion. The Connecticut value resulting from the economic obsolescence adjustment based on their cost/income approach was based on a one-year snapshot for a company in the first full year of operation. That is not reliable value either. To value an income-producing property based on the first year of operation following an expansion would be like valuing an apartment complex based on its income in the first year without considering stabilized occupancy. The cost/income approach value of $950,000 is not representative of the whole story. The two traditional cost approach valuations developed by Connecticut using versions of the Chilton formula indicate values of $1.4 and $1.7 million. For the 2017 valuation prepared by the Assessor's Office, the South Pass system was valued using 50% economic obsolescence. An adjustment of 57% was applied to the South Pass system in 2016. A 50.2% adjustment was applied in 2015. The 50% economic adjustment for 2017 is consistent with past years and takes into consideration both throughput and Connecticut's improving financial status. A 50% obsolescence factor was applied to derive the 2017 fair market value for the assessment. The indicated value of the assessment fair market value was $2.3 million. Connecticut had no pipelines prior to the acquisition of the Tennessee gas pipelines. The pipelines acquired from Tennessee Gas Pipeline were not constructed to meet Connecticut's specifications. The throughput needs of Connecticut were not considered in their design or construction. As already discussed, throughput has been reported by Connecticut as unchanged since determined in 2010 and 2011 for the FERC filings. It has been stable for 8 years if counting the 2018 rendition. Does Connecticut anticipate utilizing the South Pass pipeline system at full capacity? Is the 14% throughput for the last 8 years all there is and all Connecticut ever expects there to be? A textbook obsolescence example raises the question of an alternative valuation approach in a situation such as Connecticut's. The textbook example is of a plant with a production line capability of 1,000 units per day, which was operating at 750 units per day because of increased competition in the market. The inutility was calculated just like Connecticut does, using the Chilton formula, and the property value was adjusted based on indicated percentage of economic obsolescence. But wait, following the example, the textbook discussion turned away from the calculation using the Chilton formula because of what is described as a valid question. The valid question is, was the proper capacity used to develop the replacement cost new? The textbook answer, if the conditions are such that the long-term production will continue to be 750 units per day, it is more appropriate to calculate replacement cost new based on a 750 unit per day plant instead of a 1,000 per day unit per day plant. The conclusion, if inutility is anticipated to continue on, then it is not inutility or economic obsolescence at all, but functional obsolescence instead. And the value should be based on the replacement cost of what is used, not what could be used and isn't. So Connecticut's pipeline as it exists in place is perhaps not suffering from underutilization and economic obsolescence. Connecticut's pipeline perhaps is suffering from having been tailor-built for someone else, someone who operated a public service pipeline, not a local gathering system, and someone who needed a capacity that perhaps Connecticut will never need or come close to utilizing. Utilizing a value new that replaces what is being used and not what is not used makes sense. The presence of economic obsolescence perhaps should be rethought. After all, there are not other pipelines submitting Chilton factors in our office, and there are no other pipelines appealing in our office, and there are no objections at the Rules and Regulations hearings to pipeline prices per mile. Industry and the assessors agree on the values, except for that one curve fit issue in which industry reps disagree with other industry reps. This is not an industry-wide issue, which economic obsolescence issues tend to be. Connecticut's submission hasn't changed with the changes in the economy or the changes in gas prices over the last 8 years. Their submission is the same, year in and year out. Their exact same inutility continues on and on. Therefore, shouldn't the question be, what size smaller diameter pipe would be necessary to handle Connecticut's anticipated throughput if the pipeline were to be replaced? The existing gathering lines as reported in the South Pass system vary in diameter from 4 inches to 20 inches. I don't know how to determine the appropriate diameter pipe, but I can compare the value of a smaller pipe, picking a size that is so conservative that no one can argue that the replacement cost new is too great, and see how that compares to the assessment. Using the smaller size pipe to estimate cost instead of the cost of the existing pipe eliminates completely the functional obsolescence. For the purpose of testing the reasonableness of our $2.3 million assessment, the smallest pipe size on the schedule is plugged in across the board, effectively replacing the whole South Pass system with 2-inch pipes instead of its current 4-inch to 20-inch pipes. Calculating the 69.5777 miles of 2-inch pipes at $174,640 per mile and multiplying by the appropriate percent good based on each pipeline's age as provided by Connecticut indicates a market value of $2,488,000, say $2.5 million. The 2007 assessment of the South Pass system in Plaquemines Parish is $2.3 million. I close by respectively asking the Commission to uphold the assessed value of the South Pass system. Our office has followed the rules and regulations set forth by the Commission and developed a value taking it into consideration and making necessary adjustments as needed for all forms of depreciation, physical, functional, economic, and as a result of this hearing, we've revisited that value and concluded again, and from a different angle even, that the fair market value of $2.3 million is well within reason. Thank you very much.
If you don't mind, I have just a few questions that I would like to ask Assessor Hazel to kind of streamline the comments that she just made.
Sure, go ahead.
Assessor Hazel, you had said when you were discussing Connecticut's calculations when they performed the income and market approaches, those were premised on the use of a $4.5 million allocated purchase price, correct?
That's correct.
And did Connecticut give you any information to explain to you how they determined that $4.5 million allocated purchase price?
No.
And in fact, don't the Commission's rules instruct assessors that allocated purchase price is not indicative of proof of fair market value in Louisiana?
They do.
And I believe you also said that Connecticut has rendered a 14% throughput since 2010. So that would be 8 years of consistently rendering the same throughput, correct?
It's based on the throughput from 2010.
And can you remind the Commission, what was the economic obsolescence given to Connecticut's pipeline in 2015 and 2016?
We went from 50.2% to 57% to this year's 50%. And this year's numbers had financial that was in the black, not in the red.
So is the only difference for 2017, since the throughput has been 14% for the last 8 years, is the only difference between the last few years and 2017 the fact that Connecticut is actually now showing a positive net income and financial improvement for the company?
That is correct.
And did you perform this same kind of economic obsolescence analysis for all pipeline throughout Plaquemines Parish?
We absolutely do. We use the cost approach.
And have any other pipeline companies appealed your economic obsolescence values
No.
for 2017?
No, not for this year.
Thank you.
So it went from 50% to 57% in 2016. Any particular reason for that adjustment? Or
Financial information
financial
considered.
information? Okay. And it has improved from 16 to 2017, the financial information?
They now have a net operating income of
But we actually adjusted it down 7% for 50% obsolescence?
I'm sorry?
So for 2017, it's 50%?
Oh, we went from 57 to 50%. Is that what you're asking?
Ms. Hazel, in your comments, you said there was some discrepancy. There could possibly be 100 miles of pipeline?
Connecticut has a wonderful website, and they list their jurisdictional pipelines, and on another page they list their non-jurisdictional pipelines, which this is one of, and it shows South Pass as having 100 miles of pipe out of the 324 acquired.
But you're only really picking up 69.
We're picking up 67 or 69.5777.
Okay.
Any further questions or comments?
Yes, I'd like to comment. Anytime you ask for financials, I mean, income statement, balance sheet, you're basically looking at income approach. I mean, anytime you perform an income approach, you're basically doing a, quote, unit, because you can't break out the assets in Plaquemines Parish by, you know, everything by parish, by pipe size, that sort of thing. So you're looking at a unit. And typically with this, I think his name is Dr. Alfred Ring theory, you know, to calculate a income shortfall, you would take the market rate and compare it to their rate of return. And then, you know, you either come up with income shortfall or you come up with an enhancement. But those, either enhancement or a shortfall is applied to the actual historical cost, or in this case, the allocated purchase price. The purchase price was based on an 8-inch equivalent. As far as that, the jurisdictional assets, there was a lot more plants involved, more facilities, more pipe. So most of the value went there. I mean, there's probably gap rules that tell you how, you know, to allocate a purchase price. They've got professionals that, you know, do that for a business, an allocation purchase price appraisal. So it is what it is. And, you know, like I say, when you do the income approach and try to do a cost approach, you, like I say, you have an enhancement or you have a shortfall. And you basically come back to the income approach. Like in this case, you know, she's saying that the rate of return was 40%. Well, say if a cap rate was 10%, that's 4 times. So you take 4 and multiply it, but multiply the purchase price or the gross plant times 4. And basically the equation is circular and comes back to the income approach. And in the past, you know, there was a loss, and, you know, the parish would go in there and mark up, you know, oh, I think this expense is too high, you know, and try to get to an income and calculate a shortfall and apply it to a replacement cost schedule.
What was the income approach used in previous years?
Well, this was the first year that they actually made a net income. And that was due to the, totally due to the TC offshore acquisition, the jurisdictional assets that were dropped down to KME were 100% in federal waters, and because of the revenues on the offshore pipe, they had an income for the first time.
Okay.
I mean, you know, basically in the past, I just tried to work with them because it's not much you can do with an income, well, a loss.
Right, understood. Any more questions, commissioners, comments, motions?
I'm prepared to make a motion if I'm in line.
Sure.
I would move on docket number 17-22075-035 that we uphold the Board of Review value for Plaquemine Parish as presented.
I would second that.
Commissioner Vercher,
Yes.
Commissioner Wagasback.
Yes.
Commissioner Wood,
Yes.
Commissioner West.
Yes.
And Chairman Shahardi is absent.
Thank you, Commissioners.
Thank you.
Thank you.
Thank you.
Be careful going back. You'll need a 5-minute recess.
I was here anyway.
All right, we'll take a 5-minute recess, and so we'll start with the first Orleans Parish Appeal A in 5 minutes. Thank you. Okay, it's 12:02 p.m., so we'll be back on the record now. I would like to entertain a motion to move C, the appeal of Gail Budusky, okay, versus Orleans Parish Board of Review docket 17-22173-030. Move it to take A spot for right now.
Second.
Okay.
Second it. Commissioner Vercher is gone. Commissioner Wagsback?
Yes.
Commissioner Wood?
Yes.
Commissioner West?
Yes.
And Chairman Shahardy is absent.
Let's go ahead and swear in the Orleans Parish witnesses.
Raise your right hand. You swear or affirm the testimony you're about to give the truth, the whole truth, and nothing but the truth, so help you God.
Marcel Amaraz, I do.
Thank you.
Okay, Ms. Budusky, we'll start with you.
Well, good morning. I've learned a lot from the first discussion. It was very interesting. Believe me, this won't take very long. My name is Gail Budusky. I am an appraiser working in New Orleans, and I am the owner of 500 Mandeville Street, Unit 7 in the Spice Factory condos. I have had a contract with the Tax Commission as a consultant for over 15 years, and I am speaking here for myself, representing myself for my property. I've lived there 22 years in this condominium. The reason I am here is this is the second time before you for the same thing, uniformity, conformity. In 2016, I was before the Tax Commission, and the information that was presented to you then is updated in your appeal file that you have now for me. If you don't see what I'm holding up, please let me know. I have multiples of them. It's inside of the appeal. What this says is the yellow highlighted areas, the yellow highlights are condominium developments. The 1, 2, 3, 4, and 5 in here, these are the developments that were brought into you in 2016. The Spice Factory condominiums, of which I own one, had an increase in the total value of the condominium, and these condominiums inside of the map 8 for the ward that we're in showed no variation in assessment. So our assessment has gone up when no one else's has. At that point in time, 3 years ago, the answer that was given by the assessor's representative was that everyone had gone up because they changed the land value from, I don't know, $2 to $8 a square foot, and therefore everyone had changed. What was happening is they were taking the condominium total value and reallocating it. Okay. So the little chart that you see, and I can...
If I may, could I have a copy of that? I didn't receive your information. I didn't receive your information, no.
Here you go.
Thank you.
So what I did was update it. So you can see, does everyone have it? Do you have this to look at? Because they're sitting here, I can pass them. Okay.
Yes, we have.
Okay, all right. If you see Unit 7 down at the bottom of the chart, you'll see 2015 total value. Then in 16 it went up substantially, and it was appealed. It was reduced back down to 2015. In 2017 it remained flat, and then this year it went up again. Even though on the tax bill, the assessor's information, it shows still under this board's jurisdiction with the STR 16 here. It was lifted anyway. So then I decided, well, maybe everybody's was lifted. Maybe we were now in parity. And I was actually very excited because in our neighborhood the values are going up, and it would be nice to have everyone on the tax rolls in order to lift up the income coming into the city. I truly believe that. So I started looking, and the more I looked, the wilder it got, because nothing had changed. And in one instance, something actually went down, which surprised me. But that's beside the point. So, what you have here is an overview. And the verification of what is on this chart is in my research file. When I was here before, if anyone was on the board before, the research file was about this thick and was turned over to you to see. I don't think you need my updated file, but if you need it, I will leave it. So what I'm asking for is a continuation from the first appeal that I was here for in 16 for the 2018, and hopefully by 2019, all of the condominiums in Faubourg-Marigny in the district ward that I'm in will be brought up to parity, brought up to uniformity. I think that's wonderful. I have nothing else to ask because I know value and what I'm asking are two different things. Thank you. I appreciate being able to be here.
All these condos that you've listed and gotten values on are from the Marigny area, correct? All within your...
Well, they're walking distance from the one I live in.
Was there any, did you look at any Spice Factory condos? Like
yes, they were all lifted, except for none of what I have here is an age freeze. Anything that was an age freeze was not in my research.
So everybody in the Spice Factory condos were lifted?
Yes.
Okay. Right.
Yes.
Okay. Orleans Parish?
Good morning, Commissioners. Russell Amaros for the Orleans Parish Assessor's Office. We came in 2016 for this appeal and presented information where this condominium was revalued. Each condominium in the Orleans Parish is its own microcosm, where each condominium is valued comparable to itself, if applicable, if there are sales in the development. The Tax Commission overruled our value, the BOR's value, and staff's recommendation because they said since we did not do the entire neighborhood, they're going to roll it back to the previous value that it was. Ms. Badusky is correct. 17 does have the same value as 16's lowering because by the time we got the verdict from the Tax Commission, we did not have the ability to revalue for 2017. In 2018, we did the entire neighborhood. Therefore, I feel that the equity issue is not appropriate because the whole reason why the Tax Commission lowered the value to the previous value of 2015 was we hadn't done the whole neighborhood. We'd only done that condo. We have since revalued that entire neighborhood. Therefore, the equity argument does not, the equity argument is not applicable. We have revalued every single one of these condos. It is the assessor's office practice to revalue portions of the city each 4 years until the entire city is done. Whether or not that's not going to be the position in the future because the law was subsequently changed to do the whole city at once. But this revaluation fell under the prior revaluation technique, which is a quarter of the city, quarter of the city, quarter of the city. In 2016, it came to our attention that we had missed the Spice Factory and did not revalue it, so we revalued it. It was the only condo in the Faubourg-Marigny to be redone for 2016. The others were done 15, 14, and 13. In 2018, we did the entire neighborhood. So we would like the Tax Commission to uphold the value of the Tax Commission staff appraiser's value and put them on at a fair market value. The law does not state that every property must be on for the same price. That's not equity. That's not an equitable value. That's not a fair value. The equity and fairness that is upheld by IAAO and the governing bodies is that properties must be valued accordingly. You can't do one condo at a cost approach to value and one at an income approach to value, one at a market approach to value. That's fair and equitable. You value each property type consistently. We have valued each condo in the city of New Orleans based on a market value according to the units that have sold in their market value. I'm sorry, in their development. There have been sales in the development. In 13, there was a sale for $311 a square foot. In 14, there was a sale in the condo for $240 a square foot. Our market value is within that range. It's not 311, it's not 240. It is a market approach to value based on sales and comparable sales in the surrounding area. We think that the tax commission should not roll back the value to a 2015 value, because the argument of the taxpayer is that it's not equitable. They only raised me, they didn't raise anybody else, they didn't revalue the entire neighborhood. Commissioner Wood last year asked me if we did the entire neighborhood, and I told her no, we did not. Well, 2018 we did, and therefore equity is not an argument, or not applicable argument, because each property has been revalued.
So all the condos that she had listed in comparison, they've all been revalued?
They have been revalued for the 2015 appraisal date, correct.
Okay. So that's why since 2015 they've been level in their amounts. You guys had just left out this particular Spice Factory condos?
Yes, sir.
Part of that neighborhood?
Yes,
so that was,
Commissioner.
okay.
I take offense with this. First of all, if you look at the number one here.
Well, let's let him finish, and then you can ask him some questions on that. If you
All
like.
right.
Let's let him.
I mean, that's basically my argument. The reason the tax commission lowered the value was that we only valued their condominium development, and I think maybe 2 other condominium developments in the whole Faubourg area, Marigny area. And they said, you guys said that you had to roll it back because we didn't do the whole thing. We did the whole thing this time. I think that speaks for itself.
Yes, ma'am.
My question, if you did the whole thing this time, why is there no lift in here when we have rising values in Faubourg Marigny? I know that you did the single family around the blocks that I live in because I checked.
Mm-hmm.
So the first thing I did was check. The reassessment that you're talking about is for single family residential. It is improbable and illogical that a condominium that was I acquired for $150,000 when I bought it. It's very unusual to have a condominium that was acquired in, let me see, on the first one up here, it was acquired for $169,000 in 2015. I'm sorry. It was acquired for $155,000 in 2011, and it's on the rolls at $147,100. That's totally illogical, and I'm an appraiser. The next one, acquired in 2014 for $182,000, and it's on the rolls for $128,300. There's something wrong with that. Acquired, the next one, 2011, it was acquired for $115,000, and it's on for $128,300. The next one, it was acquired at $103. Was acquired. One or 3 units. This is an older acquisition. It's never gone up over the total time it's been held. Number 4, 811 Marigny. This one has been stable. It was acquired for in 2013 for $299,900. And it's on the rolls for $269,900 in an up market. The market is increasing. I'm working in the quarter now. I'm doing work on Decatur and Charters. This is the area I live in, and it's the area I understand well. Let's go down to number 5. Unit A was acquired in 2010 for $230,000. In 2015, it was on for $281,600, and then it went down. And I can tell you why it went down. What was going on here is they were reallocating the land value, and they were reducing their idea of valuation is to redo the land, and instead of doing the value of the whole, they just subtracted the increase in the land value from the improvements. That's where this is coming from.
I take offense to this. The assessor's office revalued each condominium based on the market value provided in the sales for the developments. You cannot compare your condominium to other condominiums in the city.
How do you think people appraise?
You need to use sales in your development first, and there are sales in your development.
And sales in the other ones too.
You have said that You have said that you have no issue with the value. You have an issue with the equity of the valuation.
Yes.
We have revalued this neighborhood. This entire development has, this entire neighborhood has been revalued as of January 1, 2015. That is our stance.
So for 15, 16, 17, 18, it should be pretty much level in values. It's just that you had to go back and redo this one because it hadn't been done in 2015, or as of the 2015 valuation, correct?
Yes, sir.
Okay. All right. And it is hard when we're looking at condos that may not be
They are
similar.
comparable. This, what I'm looking at.
Well, we'll got a staff appraisal who's got some
Okay.
comps. Maybe he can go through that. So
Okay,
go from there.
okay.
Does that make sense? Okay.
Yeah, sure.
All right.
All right, thank you. Patrick Matthew, Louisiana Tax Commission appraiser. I personally inspected this property. Like was said, this property was done 2 years ago. In turn, since the effective date has not changed, effectively my appraisal has not changed since then. You'll see three comparables in my report. Unit 1 or sale 1 being 1 unit in the development, and sale 2 and 3 being in condo developments in and around the Fallbrook-Marigny off of Esplanade and Spain Street. You'll see after adjustments, they range from $309,255 to $353,700. I gave equal weight to all 3 sales, and a value of $327,000 was reached for the property using the market approach. I'll be happy to answer any questions if you have any.
So that square foot price was
$268.69 a square foot.
269?
268.69.
as of 2015.
Yes, as of 1/1/2015. If just for completeness, that would be the land value of $40,100, which was undisputed. Whole property of $327,000, and an improvement value of $286,900.
Okay.
And these comps were not just in the same?
No, one is in the same development, and then the other one was on, I believe, Spain Street and Esplanade Avenue. All the sales took place within roughly 6 months of 1/1/15.
I noticed the one in the same unit was a base. Square footage on this one is about 1,600.
This one is 1,217 square feet.
Yeah, gotcha. All right, so we have a staff appraisal that's pretty much in line with the assessor, and you guys are appealing to Board of Review. Board of Review did do an adjustment at 290. I'm not sure exactly what their reasons were.
I'm not sure what the reasons are either, and I hate to speculate.
So with staff appraisal not too far from assessor's office, anybody have any more questions or motion?
May I speak, please?
Yes, ma'am.
I have a problem with what Mr. Is it Alvarez?
That's close enough.
Is saying. I would like to see the assessor's files on doing an appraisal or an assessment valuation on these condominium regimes, because it makes no sense to me. I cannot believe that an assessor only works within a condominium association. That is illogical in appraisal methodology, and it's never used by an appraiser that's working in the field. If that were the case, I would have known to look at all the sales in these condos before I came to this Board of Review, this Tax Commission hearing. And I can assure you that there are sales in these developments. Once something hits the market in Marigny, it sells like this. It sells extremely quickly, especially if you have parking in a pool like the one on Spain Street does. So, what I am saying is I do not believe what has been spoken over here. I would like to see the work behind what he says.
Well, you'll certainly have, you can make an appointment with the assessor. I'm sure most of this is
'Cause
I'm not sure what's public record in his space or not. That's not for me to determine.
I cannot believe.
Well, let me ask you this. With Mr. Matthews' appraisal, have you looked at it?
Yes, I have.
Okay, are you satisfied
I have no
with that?
problem with the value. I have a problem with these other condominium associations not being valued at parity with the market. These are not their market values.
And I think I understand, you're arguing equity, that everybody was not appraised the same, and I think that was what came in last time, and we did talk about the neighborhoods being appraised. And I understand your point, that you're saying it didn't happen, but we have the appraiser saying it did. I mean, the assessor saying it did, and
So
you're saying that you don't think that
That
this-
is so. And if you like, when we finish here, I will certainly get the information and provide it to you. I have no problem with that. I just have to take the time to do it. I'm hooked up to the conveyance office.
I would say that if the commission rolls back the value, it would create an even more disparity and inequity because only 2 properties have appealed, so you would only be rolling 2 out of 14. So that would be even more of a disparity.
And there's a reduction already from the Board of Review, and you do realize you have somewhere else to go after this, that
I would not do that. That is not in my psyche. My psyche is here. I'm an appraiser. I'm looking to see that everyone is appraised and the values go up in the neighborhood so that there's more money coming into the tax digest.
Again, yeah, I appreciate the list you provided, but unless we can determine the square footages and conditions of each of those properties and use it as a comparable, it's kind of hard for us to determine the equity argument, you follow me? Or the fairness in your assessment versus theirs, okay?
I just don't believe.
That's why we have to rely on staff.
Yeah, I know.
Oh.
I don't believe what's been said is so.
Okay.
That's my feeling. I would then have to prove it.
here
And
now
I
for
can-
us to know.
Yes,
That
yes.
is the
Unfortunately,
crux of the
Yes.
problem.
yeah, unfortunately,
Yes.
we don't have the open time to do that.
I
so,
understand.
yeah.
I understand.
Okay.
It is, I understand.
All right.
But I will do it.
Okay,
And I will send it.
there's always next year,
I will send it to Chuck.
understand, okay,
So that you'll have it.
Thank
So
you.
you'll know
appreciate it.
when you vote.
Okay. Okay, if there's no more questions, we'll go ahead and entertain a motion.
I'm going to make a motion in the matter of docket number 17-22-173-030 that we uphold the Board of Review value. Let me see if I have that. $290,000, that's $40,100 for land and $249,900 for improvements.
I'll second.
Commissioner Vercher is absent. Commissioner Waxback?
Yes,
Commissioner Wood?
Yes.
Commissioner West?
Yes.
And Chairman Shahardy is absent.
I thank you very
Thank
much.
you.
I really do.
thank you, ma'am.
Thank you.
Okay, we'll now move to the appeal of Mr. Edward E. Cherie, Jr., Orleans Parish Board of Review, docket number 17-22173-027. I believe this is same condo regime, just a different unit.
Yes.
Okay, you're welcome to start.
Okay, my name is Edward Cherie. I've been living in the spice factory for about 9 years, and I essentially have the same proposal that Ms. Badusky came up with. I feel that we're not being handled in a fair and equitable manner, and I would like to request that we go back to the system or the assessment we had last year.
And the assessment that you had last year
In other words, the
was-
reduced assessment that we had agreed.
was that 321,800?
Yes.
Yes.
And yours is an equity argument as well?
Yes, it is.
All right. Okay, that's it?
That's
All
it.
right.
And we have the same position as Ms. Badusky. We We valued the property last year. The argument was we didn't do the whole neighborhood. We did the whole neighborhood this year. The board review actually came into the value of the staff appraiser's value at $357, which is the same value we tried to settle with last year. We're asking you to uphold the BOR's value.
Okay. Staff? Yep.
Thank you, Patrick Matthew, Louisiana Tax Commission. Person inspected the property, 500 Mandeville Street, Unit 9. You'll see market approaches in my appraisal using the same 3 comparable sales that were used in Mr. Badusky's report. One thing of note, you'll notice this is a slightly bigger unit, hence a little bit change in some of the square footage adjustments. Everything else as far as amenities and parking are the same. After adjustments, the sales range from $339,624 to $387,977. I gave equal weight to all 3 sales. And arrived at a market value of $357,000 with a land value of $48,100, which was undisputed, and an improvement value of $308,900.
Just curious, what kind of spices were made in this particular warehouse?
It belonged to Paul Prudhomme.
Paul Prudhomme?
Mm-hmm.
Wow. So was it kind of, mesmerized into the wood and the grain? You get a little spice kick when you walk in, you kind of?
Yeah, slightly.
Maybe that's the added value here. I don't know.
Yeah.
Okay. All right. That's all the questions I have, Paul. Anything? Motion?
I'm reading comments. No, I don't have.
I'd like to go ahead and make a motion if that's okay.
Yes.
I'll move in the matter of docket number 17-22173-027 that we uphold the Board of Review value of land $48,100, improvements $308,900, and total value of $357,000.
I'll second it.
Commissioner Vercher is absent. Commissioner Waxback?
Yes.
Commissioner Wood?
Yes.
Commissioner West?
Yes.
And Chairman Shahardy is absent.
Thank you, sir.
Thank you.
Thank you very much.
We do look forward to your information.
Thank you.
And hopefully it will allow your skepticism and you will find that it was done.
Be careful. Okay. I think we'll get back on regular order now. I think the next appeal line is Appeal B, Appeal of Frank H. Howell versus Orleans Parish Board of Review, correct?
That's the one that's not present.
Oh, he's not present.
Yeah.
Okay, let's go to
Mr. Grady up.
Yeah.
So, a motion to change the switch it out to here D now. Appeal of Charles Grady.
I'll second that.
Excuse me. Commissioner Vercher is absent. Commissioner Waxback?
Yes.
Commissioner Wood?
Yes.
Commissioner West?
Yes.
And Chairman Shahardy is absent.
Okay, so up now is Appeal of Charles Grady versus Orleans Parish Board of Review, docket number 17-22173-032. Mr. Grady?
How you doing, sir? I'm here today to contest the Orleans Parish tax assessment of the property that I bought. This is 2236 Monticello Street in the lower ninth ward. I received the tax assessment. This was a while ago, I believe in.
Why don't you speak a little louder?
Okay. This is in the exhibits, and it's Exhibit D. And let me get back there. Yeah, it looks like the date on there is July 17th, 2017, and the initial assessment was $7,200 for the property. And my first reaction when I saw that was, well, I bought the property through NORA, the New Orleans Redevelopment Authority. I paid $3,500 for it, so I didn't want to pay twice, a little bit more than double than what I had paid for. So I started the appeal process with the New Orleans, or the assessor's office, and my initial request was for $5,200, and I requested $5,200 because I was unsure what amount should I, put down. It's my first time. I'm actually putting a multi-unit family property on the lot as we speak, or I'm in the process of doing that. So I'm learning as I go. But I put down the request of 5,200 via email. I got a notice back from the assessor's office saying that a hearing would take place for the value for the requested amount. I was waiting for that hearing to come, and I received the notice after the notice of the hearing, after the hearing had already occurred. And so once I received the notice, I called over to the office, and this is still Exhibit D, and it's the Orleans Parish Board of Review at Valerian Property Tax Appeals. I called the number located down there. I spoke to a gentleman there. I cannot remember his name, and I told him, well, I informed him of the situation. I said I would have liked to attend this hearing, but I received the notice of the hearing after the fact. And he informed me that, he said, well, Mr. Grady, they're probably going to rule in favor of the requested amount. And I told him, I said, well, since it's been some time since I initially put in the appeal to the actual appeal date, upon some further review, I said, I paid $3,500 for it. That's what I want to pay taxes on. That's, fair. And he said, well, if you want to address the issue further, you have to take it up with the Louisiana Tax Commission. So that's what I did. And
so let me recap this. The original assessment was $7,200.
Correct.
It was heard in front of the Board of Review. They adjusted it to the $5,200, which was your request at the Board of Review initially, correct?
Yes.
Okay. So you're here before us today now requesting it to go to $3,500?
Yeah, because they said that there was going to be a hearing, actual physical hearing. When I requested the $5,200, that was online via the online appeal process. They said once the decision was made, there was going to be a hearing. You can attend that hearing. The attendance was not required; it's not mandatory. But like after I said that's what I had thought about it, upon further reflection, I said, that's not okay with me. So I want to attend the hearing, but I could not attend the hearing because they mailed the notice out after the.
So had you attended the hearing, you may have argued for $3,500.
Yeah, that's exactly what I would have done.
All right.
And when did you buy the property?
I bought the property in May of 2017. That's in Exhibit A, the cash and sale owner's policy.
Okay, so basically your argument is that you want to pay taxes on the purchase price of your property.
Yeah, exactly. And when I spoke to the assessor's office, they said they accepted the $5,200, but I said for reasons why, and they called. It was a few days before not a few days, but after I had submitted my exhibits to the assessor's office, I got a phone call from them asking me to settle for $5,200, and I rejected that $5,200 because I said that was the number that I initially offered you in the online appeal process. That's not going to work. So here we are.
Okay. Well, let's hear from Orleans Parish.
Good morning, Commissioners, or afternoon. We initially valued the property $7,200, which is $1.61 a square foot. We got the valuation or the request from the taxpayer at $5,200 a square foot. We did an analysis of sales in the neighborhood. There are 10 sales in the neighborhood that average $1.16 a square foot, which comes out to $5,200. So we decided to try to settle with the taxpayer for the $5,200. He declined, went to the Board of Review, and the Board of Review upheld the $5,200. We have no control over the Board of Review. We don't mail out notices or set hearings. That's the City of New Orleans. The online appeal process is through our office, through a third-party software called Modria. So we did receive his appeal and then forwarded it on to the Board of Review. But after that, we have no control as to when the hearings are scheduled, when the notices went out. But we agree that our initial valuation was high, and we accepted the valuation of $5,200 for the lot because we can have a sales analysis with multiple sales that will verify that that is an accurate valuation for his lot.
Okay. Yes, sir.
Yeah, I would like to add that I did purchase the property through NORA, through the New Orleans Redevelopment Authority, and I looked on this is from the Orleans Parish Assessor's website. This is not in the exhibits, but this is the property printout that I printed out yesterday, if you guys want to look at it or what have you. But, and I looked at who owned it before there was a Road Home Corporation. Road Home Corporation and the New Orleans Redevelopment Authority are both two nonprofit entities that don't or not excluded from paying taxes on the lot. So in the years prior to me purchasing it, no taxes were paid on that property at all. And the mission, or pretty much the mission statement of those two organizations, is to revitalize the community, get property appropriated, what have you, so people can come back in the lower ninth, et cetera, et cetera.
Were they exempt from taxation?
NORA and Road Home are both exempt from taxation,
Okay.
and that's why we feel that the $3,500 is inappropriate, because it's not an arm's length transaction. It's a governmental sale of a liquidation of assets that they acquired after Hurricane Katrina.
Understood. Okay.
And my, I guess, rebuttal to that is, why didn't they compare it to other NORA properties in that area? NORA owns thousands of properties in the lower ninth or in the New Orleans area, period. So why couldn't we do a comparison to that?
Well, maybe our appraiser can clear that up with staff.
That might be a good
You might have the comps there to discuss. Yes, sir.
Charles Dickey, Appraisal Division Supervisor for the Tax Commission. I contacted Mr. Brady upon receiving the paperwork, mystified as you might expect, because it appeared to me that he had received the value that he had asked for by the Board of Review, and he explained to me about the purchase and how he felt like that the property would be more appropriately valued at that purchase price. I engaged him in conversation about that and explained to him that Tax Commission guidelines for doing appraisals, as well as appraisals in general, as far as I know, prohibit, I should say, require us to use arm's length transactions in determining the valuation of a property, and specifically exclude transactions that include nonprofits, families, government agencies, and such. Therefore, the sale that he was citing for the valuation, I've told him I didn't think it was appropriate for us to include, and I explained to him that we had done a land study in the Ninth Ward in the end of 2016, which gave us a pretty good idea of what the properties in there were worth. That was a mass appraisal type of study, looking at all the land in there, which indicated $1.20 was a reasonable per square foot value in that area, but it wasn't obviously an appraisal of an individual lot, which I did here. To do the appraisal here, I identified 3 properties within a few blocks of his. I went out and inspected the property. I looked at the sales of the comparable properties and determined that the valuation of $1.16 or $5,200 was an appropriate value based on market sales. The difference we have here is the question of whether the road home sale or the New Orleans redevelopment thing is an appropriate sale to include in an appraisal. In our opinion, it is not. And when you use the market value sales, we end up on the same number that the assessor quoted just a moment ago. I looked at the same sales he did, and $1.16 is the number.
Could you expound on why it wouldn't be considered appropriate so Mr. Grady would understand? Because I think he has a reasonable argument, and I understand that there's a valuation that
I'm
you've
sure
done.
I believe it is.
Yes.
I haven't asked him about this, but I'm assuming most of us here are familiar with what occurred after the hurricane and the effect that it had over areas like the lower nine. Much of that property was taken over by the road home, where people were given a stipend or a cash value or whatever based on an appraisal number. And at some point, the road home had, as you might expect, a whole lot of property to dispose of and no way to do it. So they handed it back over to the city, and the city developed the New Orleans Redevelopment Organization in order to do that. They have sent, is that not correct?
No.
Okay.
I chaired the redevelopment.
There you go. Well, good. Well, enlighten me if you
Called
would.
Old Community Improvement Agency.
I'm sorry, sir?
Community Improvement Agency was the original name.
I see.
It changed its name under the Morial administration to the New Orleans Redevelopment Authority. Its purpose is to develop blighted property, it was set up to deal with blighted properties in the neighborhood. So the road home transferred properties to the Louisiana Land Trust.
I've apparently missed some steps here, but I think we're
Yeah.
on the same road, so to
Right.
speak.
So I'm a little leaning towards that it should be equated as a fair transaction based on the incentives of the agency's purpose and goal.
In an appraisal situation, one of the things you look for is motivated sellers and motivated buyers. And in this instance, I believe the amount of property that the city still has on the, with whatever agency it might be, motivates them to essentially unload as much of that property as quickly as they can to get it back into commerce.
But I believe they have to, they can't do it less than the fair market value of the property.
I would tell you that no appraiser in town would have seen this number as a fair market value because there are no sales to support it. There were no sales in the lower nine to support.
Somebody had to do it for Nora to be able to sell. They had to get an appraisal. They had to get 3 appraisals. So.
Well, you have 3 here, one from the assessor's office, one from the board review, and one from me. And we all looked at the same sales data. I don't have any idea what data they're limited to. We have a window of 2014 and 15, an effective date of 1/1/15, and looking at the sales that we consider arm's length transactions in that period of time in the lower 9, this is the correct number.
Okay. So based on that average square foot sale of the comps that you looked at, the 3 comps, you're arriving at $5,200 as well?
Yes, sir.
Okay. All right. Yes, sir?
Oh, yeah, I'd also like to point out in the appraisal here that the photo of the property is not the photo of the property. I want to make that real clear. And this was in the appraiser that was mailed to me by Mr. Dickey. So the photo that you're looking at is not the photo of the property.
Yeah, this appears to be well.
There are no.
It says Monticello, but it is not Monticello.
I would dispute the fact that it's not on Monticello. However,
excuse me, 2236.
There are no, correct. There are no addresses. Most of this property is vacant. Several of the houses that are still there are blighted. There's one house on the block that has a number. So I estimated what the lot might be. I can tell you the lots pretty much look the same going up and down.
Is your lot similar as far as you don't have a big hole or any type of structure on your lot?
No, it's a vacant lot. Yeah,
okay.
There's a tree on it. There's nothing, out of the ordinary.
So for purposes of the appraisal, the land is a land, it's comparable land, and I guess photos of the subject property really help us determine based on the improvements. Or
Yeah,
the value of the improvements.
There hasn't been any
no
improvements yet,
okay.
not yet.
All right.
And I wanted to point
we'll
that out.
We'll note that for the record. That's
okay.
wrong for that.
I apologize.
No, it's okay. And that's the real, I guess, crux or reasoning behind it is these programs, the New Orleans Redevelopment Authority and the Road Home Corporation, are designed to have people come in there and revitalize the community. And that is exactly what I'm doing. The 3 comps that Mr. Dickey, the 3 properties that he did, I pulled them up on the Orleans Assessor's website. All of them are vacant lots. They've been vacant for 5+ years. Nothing has been done on them. I also Google Earth these images to see where they at, versus what they had on their site and what was on the Orleans Parish website. And they were both consistent, just vacant lots. So I am doing what these programs are outlined to do, is bring someone in, a developer, what have you, to build a house there. And I've provided that in the exhibits. There's a survey and receipt report. I have construction estimates. The survey is Exhibit B. The construction estimates, I have 2 construction estimates. That's from JLV and the Russell Hall. That's Exhibit C. And Exhibit D, that's the Orleans Parish Assessor's appeal documents. Exhibit E is the completed construction plans, the fully completed construction plans for the multi-unit property that is in the process, will be built on, 2236 Monticello Street. And in Exhibit F, there's also an email to Sandy Hayden, I want to say with Iberia Bank, regarding a construction loan request. So it is in the process of that. And prior to my purchase of this land, the city collected nothing on this lot. I am bringing value to this lot by what I'm doing. And so they're going to collect more when this property is finished versus this assessment. And that's the crux of the argument. Like,
well, we appreciate you doing that, and certainly it's going to help the city and help the housing shortage, et cetera. So hopefully you'll have success with your construction and find some good tenants.
oh yeah, it will be, and that was the whole reasoning behind it. And I can't remember who I spoke with that offered the settlement. I'm not sure if it was just this gentleman or not, but it was someone from the assessor's office. And oh, excuse me, I just lost my train of thought. But yeah, he had made a point that he said, you know, well, this is not a lot of money. I said, you're absolutely right. It is not a lot of money, but all of my time, resources, energy are going to be devoted to this new place. And whatever it is, if it's $10, if it's $100, I'd rather go take that $10 and go to Home Depot and buy doorknobs for this new place that I'm going to go build.
Understood. Appreciate it. Okay. Any more comments? Motion, Paul?
Let me talk to council for a minute. You know, can we take a, how do we do this?
We can just pause and confer with council at interim station.
We can go on to the other two because they're uncontested essentially, if you would like.
Okay.
Well, we've got to have 3 in the room.
Oh, you're right.
Yeah.
Excuse me.
Yeah, it was Mr. Keith Levine who initially talked to you.
Okay, okay.
And
Yeah,
then-
I didn't remember his name.
Yeah.
Uniformity of fair market value. I have no choice. I don't have anything to reduce the value. So I have to move to accept the Board of Review's recommendation and staff recommendation. But what we need to do, I would like, I asked you to look into the redevelopment authority's policy, because there's going to be a precedent set when we do this. And they're also state agencies, so we have to see how we can move forward. For the purposes of today, I'll make a motion under docket number 22173-032 to accept the staff's appraisal and the Board of Review's recommendation at a fair market value of $5,200, being nothing for the improvements in all land.
And I would second that.
Commissioner Varcher is absent. Commissioner Wagenspat?
Yes.
Commissioner Wood?
Yes.
Commissioner West?
Yes.
And Chairman Shahardi is absent.
Mr. Grady, I want you to know that I actually toured the Ninth Ward right after Katrina with Leadership Louisiana, and I am so glad that they have a program that's going to make a difference to bring that neighborhood back, because that was devastating.
Yeah, and that's the whole,
And
exactly,
your
yeah.
work towards it is appreciated, and you're talking to two accountants here, plus Paul, who's got knowledge of it. We're sympathetic and understand. We have to do what we're bound by, but we do understand your argument, and you made a good argument.
And the, I guess the last point is, through this process, I realized when they said they were going to send me the notice, when I filed it online with the Orleans Parish office, I have no distinction between who's sending out notices, what entities or what party. That is not my fault at all. That is totally on them. Whether they have control over it or not, everything I'm dealing with is through the Orleans Parish office, through their process.
I think we've heard this complaint before.
Yeah, and I should have been able to speak on my behalf and not them have a meeting about me without me.
Even having missed that, if you had come and you had some way to prove to us that was, if you would have still had your day today. We are not upholding it just to uphold it because you were not at that hearing. You had your moment today. We heard it completely again. That does not have any bearing on us when you get here. So do know that even though you missed that,
we're not even provided notes from the Board of Review
we don't even
hearing.
know what they said in their meeting. So it would not have reflected poorly on you, even if they,
Yeah, they just neglected to give me the opportunity to speak for myself.
And that's frustrating.
I will provide that feedback to the gentleman. We have obviously a lot of communication with the folks who run the Board of Review, and I'll certainly make sure he knows that. Mr. Patterson.
Yeah, that would be nice.
Thank you.
That does need to be said.
Thank you, Ms. Grady.
Thank you very
Appreciate
much.
your patience. Okay, Ms. T, are we in line to start with E, appeal of Henry Klemick?
You can start with him, or you can go back to Mr. Howell.
Okay, let's go ahead and then go back to B. Appeal of Frank H. Howe versus Orleans Parish Board of Review, docket 17-22173-029. Doesn't appear that the taxpayer is present.
Yeah, I think he gave us a note that he was been in the hospital. And
that is correct.
He's recently been in the hospital. This appears to be a rental property that he has. Reading his letter, I think there was an issue of a sewage backup and some problems relating to a collapsed sewage line. And I don't know, he's wanting the adjustment just because I think he's been having some trouble with the property. Maybe it's been impaired by some of these issues. So maybe once we get into our staff appraisal, we can kind of update us on that. But for right now, we'll just go ahead and allow Orleans Parish to present their case.
Thank you, Commissioners. So we initially valued the property at $352,000. It was appealed by the taxpayer to the Board of Review, who then lowered the value to $315,000. We appraised it using market value for the neighborhood. We feel that our initial value was correct, and that it was accurate for his property. During the board review, he said he brought in evidence that there was extenuating circumstances, so we had no objection to the reduction to the 315. He appealed to the tax commission, and the staff appraiser came in at 292. We had no objection to actually expediting this and settling at the staff appraiser's value at 292. I reached out to Mr. Howell and told him this. He said he would talk it over with his wife and get back with me, and I guess he did not get back with me because he's been in the hospital. So I was wondering what had happened.
So to recap, you originally assessed at $352,000. Went to a board review. They adjusted to $315,000. Staff appraisal has now come back for $292,000, and he requested $280,000. So we're not too far apart here. So I guess we'll hear from our appraiser. And
I met with Mr. Howell to inspect the property. He mentioned that he had had problems in the past. It was primarily with the Surge and Water Board and their ability to get some pipes hooked up correctly that were out in the street. However, the property was in very good shape and was rented while I was there. So apparently those were problems he had had in the past. He provided me with a copy of his appraisal, which I considered, and the thing I noted was that in one of the 3 comps that he used was from 2016, which we're not able to do in the appraisals we do with the effective date of 1/1/15. If you look at the other 2 comps in his appraisal, one of them, which is right down the street on Robert E. Lee, came out to be almost exactly the same number as our appraised value. I did an income-based appraisal and a market-based appraisal. I think the 292 is a fair number. I also note that it's within 7% of the Board of Review's number, and obviously that's enough wiggle room in there either way. Okay. I did speak with him yesterday to confirm that he wasn't going to be here. Said he had been ill, and he just asked that we make sure his position was represented, that he was still standing on his appraisal.
And you said that y'all were okay with the staff appraisers?
Yes, Commissioner.
Okay.
Okay, well, we hope Mr. Howell's doing well. If you're okay if Orleans Parish is okay with the $292,000, I'll entertain a motion to that effect.
I would move that we accept the tax commission staff recommendation of land value of $18,900, improvements of $273,100, for a total of $292,000.
Second.
Commissioner Vercher is absent. Commissioner Wagasback?
Yes.
Commissioner Wood?
Yes.
Commissioner West?
Yes.
And Chairman Shahardy is absent.
Okay, we'll move on to E, appeal of Henry M. Klimick versus Orleans Parish Board of Review, docket number 17-22175-011. Doesn't appear the taxpayer is present. They submitted, I think this is originally assessed for $23,210. Board of Review ruled at $23,210. He's requesting $20,370. He's basically stating that the duplex is in poor condition when purchased, as required by building city codes. He spent a great deal of time and money on the exterior. He's now working on the interior, which remains to be done. I feel that certain reassessment was based solely on the appearance of the exterior. So apparently his exterior is fixed up, but obviously I don't know if the assessor had done an interior visit or not. I'm sure maybe our appraiser had. One side is inhabited, one side is vacant, noted on each envelope. So basically he's requesting, basically stating that his property is not in good condition on the interior, and he has one tenant as opposed to 2. So that's his complaint. So, Orleans?
We initially revalued the property using market value. I reached out to Mr. Klimick. There was a square foot discrepancy between our number and his number. Once we recalculated using the correct square footage, we were in a couple of percent points between the our new value and what the tax commission staff appraiser value was. We offered to settle. I sent him a settlement agreement, and I think he sent it back to our office. I just have not received it. That's my understanding.
So the settlement agreement is for?
The 198 of
okay,
the
staff appraisal. All right.
Yes, sir.
Okay.
I spoke with Mr. Klimick yesterday. He stated that he was in agreement with the LTC value, that he had received the paperwork, he had signed it, and he had returned it. He was under the impression this was done and it was settled.
Okay.
It may be lost in the mail, too.
We have a
so-
centralized mail for City Hall, so it may not have come to our office yet. It may still be in the
So
basement.
would you like us to go ahead and rule so it can be done, or do we need to?
Yes, if you wouldn't mind ruling,
Yes,
that's,
absolutely.
All right, I'll entertain a motion to that effect.
I would move in the matter of 1722175011 that the land value be set at $38,700, improvements at $159,300 for a total fair market value of $198,000 as agreed upon by all parties.
Second.
Commissioner Vercher is absent. Commissioner Wackersback?
Yes.
Commissioner Wood?
Yes.
Commissioner West?
Yes.
And Chairman Shahardy is absent.
Okay, on item F, it has been withdrawn. Item G and H have been settled. Item A and J have been continued to April 11th of this year. Items to be considered. Up next is consideration of change orders.
all right, thank you.
Tanisha Malvo on behalf of the Louisiana Tax Commission. Today we have a total of 440 change orders. Staff has reviewed these change orders and requests that all 440, are approved.
Okay, entertain a motion.
I'll make a motion to consider all 444 change orders that staff has recommended.
I would second that.
Commissioner Vercher is absent. Commissioner Waggesback?
Yes.
Commissioner Wood?
Yes.
Commissioner West?
Yeah.
And Chairman Shahardy is absent.
All right, next we'll consider consideration of tax sale cancellations.
Tanisha Malvo on behalf of the Louisiana Tax Commission. Today we have a total of 13 tax sale cancellations. We have 2 from St. Tammany Parish for dual assessment. We have 1 from Ouachita Parish with dual assessment. We have 9 from East Baton Rouge Parish. They break down as follows. 6 for being erroneously sold and 3 for dual assessments. And lastly, we have 1 from St. Landry Parish, which was a clerical error. Staff has reviewed these tax sale cancellations and requests that we approve them.
Entertain a motion.
I would move that we accept the tax sale cancellations as recommended by the staff.
Second.
Commissioner Vercher is absent. Commissioner Waggesback?
Yes.
Commissioner Wood?
Yes.
Commissioner West?
Yes.
And Chairman Shahardy is absent.
I don't think there are any other items to come before the commission. I
Commissioner-
will read that at the conclusion of this hearing, the Tax Commission hereby accepts all pre-filed documents and oral testimony into the record as Taxpayer Exhibit 1 in Globo, Assessor Exhibit 1 in Globo, and LTC Staff Appraiser Exhibit 1 in Globo for each appeal hearing conducted today respectfully. And with that submitted, I'll entertain a motion to adjourn.
So moved.
Second.
Commissioner Vercher is absent. Commissioner Waggesback?
Yes.
Commissioner Wood?
Yes.
Commissioner West?
Yes.
And Chairman Shahardy is absent.
We got something to sign?
Yes.
Change orders and